Good evening, everyone. Time for another silver update. I had projected a move out of this descending flag formation, and I had drawn a number of resistance lines based on the tops, and we had 37, 38, and the top one is 39. You can see we moved violently through these lines, and we're approaching this line here. Not really a big one, but if we get through these lines, then we are in the process of forming a gigantic cup formation, and we'll pull it out a little bit so you can see the strength. Now you can see the MACD has gone into positive territory on this 8-hour, and we want to go out to the daily, because if you remember, I had spoken about the length of this trough from 2008, how long it took to get back through the positive MACD crossover. You can see we've already crossed over now into positive MACD cross. So will the strength be like it has been on some of the positive MACD crosses, like this one here? So you can see the strength of the move that occurred when we crossed at this point. Will we see that? I don't know. I think we might. And I'm going to spend the rest of the time I have tonight to read to you a Jim Willie article that I just came across. I have tremendous respect for Jim Willie. I think that he's been spot on, and you have to ask, who's been right in this whole thing, and I think Jim Willie has pretty much called everything. But we can start to view this dip below this trend line as a sort of anomaly, kind of like we had back in 2008. And the move today is spectacular. I can't cover all the news because I haven't seen it all, and I don't have time to do it, but my understanding is that Bernanke was before Congress today, stammering and stuttering and doing his usual, which is looking like a bird in the gun sights. I mean, it's pretty embarrassing how nervous this guy is when he has to testify. There was a interaction with Ron Paul about him asking whether gold is money, and Bernanke saying no, and then Ron Paul asking, then why do all central banks hold it? And a lot of stammering and stuttering. At some point I may have a chance to review that video, but the news is coming so fast and furious that at this point in time I can't go over it. So we're now crossing over the zero line in the MACD, and if we draw our line straight up, it's going to be hard, but we'll try to get it close. Go straight up. So we may be at an inflection point like we were here. So although this is a massive move to 38.30, it may be just the beginning of some really massive moves, and the silver market is starting to take shape as a runaway bull market, where you just go into new highs, you pause a little bit, and you just go higher. So we'll have to wait and see if that's the resuming trend that we've got. But I wanted to jump really quick over to gold, because my prediction was that gold was going to blast off into new highs and silver was going to follow it. That's not quite right, because gold is actually starting to lag on a percentage basis. I wanted to look at the Forex site real quick, because I wanted to look at the yearly returns for these commodities. Because if you remember back in May when we had the, what I'll term the silver flash crash, where they took the opportunity to come in on a holiday at night in Asia in the thin market and come after silver, they really took the stuffing out of silver at that point. But to take a longer view, I just want to show you the returns. And if you go to Netdania, and you can see we're trading violently a lot of these things, but here's your list of currencies. At the bottom you've got gold and silver and crude. So if you scroll over, you can see that you have your year-to-date change. And if you remember back in December in my videos, I was pointing out that silver was the unsung hero of the year. It returned 84% for the year. It was not covered in any of the press that silver was the most profitable asset of any asset class for that year, except for maybe some bubble stocks like Netflix or Apple. But as far as a wide asset class, silver was the heads-up leader. So you can see now that it is, again, that if we look for this year, and we're at July 13th for the year, so we're roughly halfway through the year, silver is now returning 24.19% for the year. Gold is behind it by more than 50% at 11.64. Crude is 7.36, and you have the various currencies. You have the Swiss franc versus the Japanese yen at about 12%, and you have the other currencies here. So you can see the US dollar's lost 13% against the Swiss franc. So, but the outstanding winner by far, again, is silver, and I expect this to continue for years to come. So I'm going to jump over to the entire Jim Willie article and read that to you, because Jim Willie is a financial analyst that I respect tremendously. He has called so many of the things that have happened and not been given credit for it. But let's go ahead and jump into the newest Jim Willie, which is the silver platter opportunity. And he says, every few years a tremendous opportunity arises. The autumn months of 2007 and the autumn months of 2008 offered such an opportunity to buy silver. That $11 silver price is long gone. Many smart folks seized it. Whatever can be said on such silver platters applies almost equally to gold. The silver sprint gains are typically much larger than the gold steady gains. The coming autumn months will feature a gaggle of supposed financial analysts, experts, backpedaling in their hasty damage control. They have been broadcasting a wide assortment of low-level propaganda posing as competent analysis, as they attempt to make the point that the anti-US dollar trade is done, the gold trade is over, the silver trade is spent. They are so wrong. A comedy of clumsy oafs and dolts on Wall Street payroll awaits the public in a grand chapter on stage. They will struggle to explain the move in silver over $50 on its way to $80 per ounce. They will struggle to explain the move in gold over $1,600 and then $1,700 per ounce. The mainstream news has been deeply involved in a delicate balancing act. They must report the news, but it is almost all very bullish for the precious metals. A new financial mini-disaster unfolds almost every week. Last 2 weeks were Greece. The next week might be Portugal. They must report the news, but it paints a picture of a broken monetary system with debased currencies. They must report the news, but it openly provides the gory blow-by-blow details of ruined sovereign debt. The United States debt situation is Greece times 100. This week, the loquacious jackass will permit some lovely pictures to tell the story. Three graphs adequately tell of a grand opportunity to latch onto the powerful gold train with a supercharged silver scout. Who were the smart buyers back in September of 2007? Actually, that was in 2008 that we hit 850 on silver, but we'll give him that. The false, phony, deceptive mainstream message then was that the subprime mortgage problem was contained. That was the first major stumbling block by the hapless, witless, clueless U.S. Fed Chairman Bernanke. He has made not a single correct economic or financial system analytic call. Who were the smart buyers back in October of 2008? The false, phony, deceptive mainstream message was then that a TARP solution was being put in place to save the U.S. banking system. The solution turned out to be basic largesse to big U.S. banks, enabling purchase of preferred shares, enabling outsized executive bonuses, and enabling secretive bailouts of banks across the globe. Without the Financial Accounting Standards Board allowance for insolvent banks to continue to dictate the value of their own balance sheets, otherwise known as systemic accounting fraud, the big U.S. banks would have been liquidated. The entire too big to fail principle is actually a battle cry to avoid solutions, to protect the banking elite that was mostly responsible for multiple trillion-dollar bond fraud and mortgage fraud. Without any reservation, it can be said that too big to fail means no solution, no remedy, no recovery, and no attempt at anything remotely resembling a road to economic recovery. In my view, too big to fail is the epitaph on the U.S. economy and the nameplate on the U.S. Treasury bond, default. So who were the dummies who ignored the opportunity to buy gold and especially silver in September 2007 and October 2008? The majority of them listened and trusted to the mainstream news, the Wall Street misdirection, and all their fallacious messages. The commitment of traders signal. A big hat tip to internet contributor RG, whose message was relayed by the Midas Report. Consider verbatim his message, in which he gleefully proclaims to be calling all rocketeers of the happy silver ship. The good fellow RG wrote, quote, "The latest commitment of traders report for silver is now screaming out at full volume, buy, buy, buy. In fact, the commercial short-long ratio that I have already bored you with at a great length in recent correspondence is now down at multi-year super extreme of 1.79. Below is an up-to-date chart of the commitment of traders picture. In summary, there have only been 4 other weeks in this whole bull cycle where the ratio has dropped below 1.8 for 4 weeks. The first 2 weeks of these was August 28th, 2007. The following week, 4th September 2007. The second tranche was the 21st of October 2008, and the following week was 28th of October 2008. If you study below both the chart of silver over that period and also the HUI gold mining index, you can see how these extreme lows below 1.8 on the ratio coincide on both occasions very markedly with a bottom in both the silver price and the mining index. On each occasion, this proved to be a multi-year opportunity to take positions in both the metal and the precious metal mining stocks. Now, I don't agree about mining stocks because I think that the collapse will wipe out all papers. So, be that as may. Each time the price of silver rose by some 60 to 90% within a 6-month period, and the HUI index rose some 90 to 160%, folks, there is no such thing as a risk-free trade. There's no such thing as a free lunch, and there's no such thing as a one-way bet. However, there are certain times in an investment cycle when an outstanding opportunity presents itself, an advantage should be taken. The evidence above shows very clearly the historic correlation between an extreme low below 1.8 on the commercial short-long ratio and a multi-month bottoming in the price of both silver and the precious metal mining stocks. I have been trading the precious metal sector since 2003, and I would consider this to be and he puts in bold, one of perhaps the 4 of the most suitable buying opportunities within the last 8 years. The man RG makes a compelling argument without providing the background factors that push gold and silver prices upward. He simply points out the commitment of traders signal and the resulting performance after 2 significant lows were registered in precious metals prices. Very convincing indeed. Thanks RG for this chart. Now you can see the blue line and then the red line, and that's the commitment of traders. So I don't have time to go into that. I'm just going to keep reading. Note the green arrow in September 2007, a strong signal when silver was at $12 an ounce. Note the green arrow in October 2008, a strong signal when silver was just above the $9 price. And those are your arrows there. The same type of signal is identified with yet another strong signal here and now in July 2011 with the silver price at $35 to $36. It is ready for the next big up leg. This time gold might lead, but as usual silver will follow and run fast and hard, making yet more breathtaking gains. So I don't have time to finish the whole article. I encourage you to read the entire Jim Willie article. He's always been spot on, but I had projected that gold, and let's go to the daily, would lead the race, and once the breakout occurred, gold was going to explode to the upside, approaching 2000. It turns out now that silver is really moving stronger than gold, which I did not expect. I actually expected silver to follow gold, but it looks now like silver is going to lead gold. That's a huge message. And again, this is a paper price, so this is just COMEX silver, and you can only put so much stock in that price, but the percentage moves on these markets, if you want to look today, silver is up. Well, we lost the percentage, but it was a large percentage gain for silver today. It was 5 to 10%, while gold was a fraction of that. So it appears that silver is leading the pack. We're at 24.22% for the year returns, and if that's the case, that is a tremendously bullish signal, in that the reaction to the Bernanke testimony and the hint at QE3 and the potential raising of debt ceiling by $2 to $3 trillion means that people reacted by buying silver even more rapidly than they bought gold. And we already know the fundamentals for silver. We know there's so little silver around for people to buy that any kind of remonetization of silver will result in an explosive price move. I'm predicting the swing rule is 60 to 70. I'm looking at 3 digits, and ultimately I'm looking at 4 digits and possibly even 5 digits for silver in the next few years, and it's going to be crazy. You need to have your physical silver in your hand. The paper markets at any point can be invalidated, and they're just going to throw them away and tell you you get nothing. So you got to accumulate physical wherever you can get it. I recommend buying, first of all, the bullion mints of the various governments, whether it's the United States with the Eagles, whether it's the Maples in Canada, whether it's, my favorite is the Perth Mint, all the series from Australia. I picked up some from New Zealand. There's the European mints, and you can pick all those up. You need to get physical, because when this whole thing comes apart, the only people left standing are the ones with physical silver. And we'll talk to you next time.